Hello. Hi. Hi, can you hear me, George?
Good morning. How are you?
Yeah, good morning. Thank you for joining me. I really appreciate it. I really appreciate it. Super grateful that you've been able to come. It's very nice of you. I hope so. I'll just let the other people come in a little bit and stuff. It's very nice of you to come. Thank you, George. I really appreciate you coming. Taking time out and participating in these calls. I have tried my best to take your questions and, when possible, kind of make an extended webinar of that. So I've tried to to take on board what you've asked and kind of go forward and spend some time thinking about it in preparation for these calls. So this right here, I've tried as much as possible to specifically talk about when to sell. So I'm going to go for about a 15-20 minutes introduction about or webinar when to sell. I'm going to try and just squarely talk about that, although it's really challenging. And then I'm going to open it up for you guys to kind of ask some questions and stuff like that. And then right at the end, I'm going to say, listen, let me know throughout this time if there is anything else you're interested in. I'm always looking for things that how to express myself in a way that's helpful. Let me just make sure, because I was expecting someone else, one person. Let me just wait to see if they're coming. I was expecting someone to show up. Okay, I don't know if they're going to come or not. Doesn't matter. I just was chatting them a few minutes. Oh, here he is. Okay, fine. Thank you. I'll just wait for James to come on board, and then I'll kick off.
Hello.
Hi, James. Can you hear me?
Hi, yes, can you hear me?
Yeah, cool. So I'm just saying, so the way I read this format is like this. I'm just going to briefly explain. I have about 15-20 minutes where I kind of talk, and I'm going to talk today about a specific topic. My specific topic is when to sell a stock. And then I'm going to open it up for some kind of questions and answers. And then that lasts about 10-15 minutes. And then after that, if you or anyone else, Tomas, this one was particularly what you said about 2 weeks ago, I think before your holiday. I can't remember if it was before your holiday. I think it was before your holiday. So if you have any kind of topics that you're interested in about investing, let me know. So this is the format that I'm going to go through today. I've tried to kind of break it up into 3 parts. The first part is when to sell a stock in terms of investors' expectations, really. What is it that we're trying to do here? And then a good sell criteria. And finally, I'm going to talk about my holding period, because that's part of the criteria that I use to when to sell a stock. Okay, so I'm just going to kick this off. So the first thing that I think is really important to focus is everybody is different in terms of investing. And it's important that you know the temperament that you have. There's no problem in you trying different styles. That's absolutely no problem at all. But it's very important that what you're doing is refining it to your style. And I think that what's also really important, and I've been quite lucky in my investing style, that I've put a record out. I've had to, put out a record, a public record of how I'm performing, so that I can see myself, like I can learn from how the market changes, and I can learn how my mindset changes with the market. And I in the ideal scenario, I'm not being led by the market. I'm actually improving so that I can see commonalities, but I don't want it to be just a fad of this week. Like let's say that something is working out right now. I don't want it to be like that. I want it to look over a period of years of what's working, what's not, but also adapting to and changing, changing your mind. I think that's something that I picked up from Super Forecasting, but there are other books about this as well. But really, in that book, Super Forecasting, it talks a lot about people that are the best forecasters. They frequently update their thesis. And I think that's so important because you start out with an idea, and it's important not to be really dogmatic. It's important to kind of change your mind as the facts change. And one thing that I've seen in my experience is people get latched on to ideas. And I think we do this everywhere, right? You have a view of XYZ person or XYZ group of people, and you kind of, someone tells you something different, then you're like, no, but that's how they are. And you like, you kind of latch on to certain ideas. And Charlie Munger has a quote, which I'm going to butcher now because I just kind of got caught off guard. But it's basically something like this, that the egg, the human brain is a lot like an egg, and the human brain is a lot like an embryo, and once the sperm comes in, like the idea comes in, it shuts off to all new ideas. And we're like that as well, that we kind of get so kind of caught up. And I see a lot of this in the comments of my articles, and I see the Cross Seeking Alpha. People kind of like, oh, but the stock was at $10 or at $100, and now it's at what? Like, that doesn't make any difference. Like, it makes no difference what the stock was last week or last month. That's no here, no there. You need to know where it's headed. It's very easy for us as investors. We love stories, and I love a story, man, and I love telling stories as well. But when you look at the share price in hindsight, and we build those narratives as investors, we say, oh, how many times, like I've seen, I'm sure you guys have seen, this is the next Amazon. Like, oh my God. Okay, and people don't say that nowadays because nowadays Amazon's kind of come down a little bit, but for a long time it's like, this is the next Amazon, or the next Netflix, or like, it's just like, we love those stories, and we kind of have to adapt our minds and not get so caught up. So when you're trying to sell a stock, I think it's very important that you understand what you're trying to do when you bought it in the first place. So you're trying to buy the future cash flows of that business. That's really what you're doing. Like, it doesn't matter if you're trading, technical analysis, all of it, none of it matters. The share price is indicative of what people value those future cash flows. Doesn't matter like what kind of style you do, like buy low, sell high, buy low, whatever. It doesn't make any difference. It's all about, you're trying to buy, you're putting away your capital today and you're deferring it for future appreciation. Now, there are different ways to go about it, and I kind of I'll highlight one recent example. I recently highlighted PayPal as a compelling investment. So this is something that I believe is very much come down in people's expectations, and provided that expectations don't compress any further, the business will kind of grow at about 10 or 15%. And over time, my return should also grow at 10 or 15%. It's not like heroic, it's not like the next GameStop or whatever, but it's kind of, it's something that is realistic. And I think it's much better to go for realistic investments rather than things where it can go really well or cannot, because those ones, once the stock is down, it really is a hurdle to come back up. And if, for example, you're down, let's say 20% on a stock, I think you need to go up like 26 or 20, something like that. I can't remember the math now. I think it's 30% to come up to break even next time. And that's like a hurdle, man. That's like so it's really important when it comes to your sell criteria that you think long and hard about what you're trying to do. The other way of investing is if a business has done really, really well. For example, Google's doing really, really well, but you still believe that even though it's done really, really well, it can still continue to do really, really well. And that's a very different type of investment to something like a PayPal, but it's really, you're trying to buy the future cash flows of the businesses that are underappreciated by investors right now. So I think that that's really what you're trying to do. So it's that expectations, that's what I'm alluding to here. So when it comes to selling a stock, I think that it's really important that you don't overstay your welcome. So this is something that is so nicely explained. I can't remember that investor now. He wrote The Margin of Safety, not Ben Graham, but it was actually the book Margin of Safety. Can't remember now his name. It'll come to me afterwards. But it talks about, when you're trying to buy a business and everybody kind of sees what you saw before, like in the past, whether it was 2 months ago or a year ago, and everyone sees that now, you don't want to kind of overstay a welcome, because businesses do go round trip. And we went through a period in, let's say, 2016 to 2020, where everything was just going up and up and up and up and up and up. And we believed that everything was a secular grower. And when the economy kind of slows down now, and you see the things actually, even though we were led to believe that these SaaS business models were invincible, actually, when the economy slows down, these businesses slow down just as much as a cyclical business, but they're still priced as if they're secular growth forever. And the stories that they spin are also that they're secular growth forever. Even though even the best of the best, like those mega cap names, you've seen how much they slow down. They've really slowed down a lot. So things, you don't want to round trip. So when it comes to selling the stock, I think that it's important when you don't want to wait until something is fully priced, because you have no idea what share price that is fully priced. You have no idea. What you're trying is to do your best. You're trying your best to buy something at a discount. Really, that's really ultimately what you want to do. And once you've been with the business for a certain amount of time, you want to sell that investment. But I believe that you don't want to go kind of just sell it abruptly, because I believe that it's too much of a brute force method. And the way that I suggest to do it is to spread it out in about 4 or 6 weeks over, let's say, 3 tranches. So you kind of ease into an investment and you ease out of the investment, because you're trying to get the average over that period of time. It's not about you looking in hindsight and say, oh, that was the cheapest point, and selling at the peak. That's artificial. And the day that you sell, the markets could be down, and you don't want to be in a position. You want to try as much as possible when it comes to this whole process, whatever your strategy is to make it repeatable. Because it's easy to say, oh, if you'd invested in Netflix and it compounded at X much money, you'd have made X much money. But that's fiction. Like, that's really just fiction, because even if Netflix was to repeat itself, it wouldn't necessarily have the same outcome. And another example would be Tesla. From my memory, once or perhaps twice, Tesla was on the verge of bankruptcy. I haven't read the latest Elon Musk book, but I think that, if memory serves me correctly, there was 2 occasions that it nearly went bankrupt. And now it's like, obviously close to $1 trillion markup. And I'm not the biggest Tesla bull, I don't really follow it that closely. But my point is that we can extrapolate what's been happening in the past as much as we want, but that's just fiction. And it's important to have these repeatable strategies, because we are investing in stocks in the public market. This is not a venture capital model where you have 1,000 businesses and you kind of put a little bit in each one and you're hoping to get a lottery ticket. That also has its trials and tribulations, but that's just a very different style of investing. And I think it's very important that you have a strategy that you can refine. That's really what I'm trying to explain here, is you're trying to refine it by being very brutal with yourself, being very objective, and saying, like, okay, don't blame something else in the market. Oh, the Fed said this or the Fed said that, interest rates are up or down, the economy is warming up or cooling down. Give yourself, don't give yourself a hard time, but be quite brutally honest about your process so that you can improve. Even if you look at someone like Charlie Munger, he invested in Alibaba, and then he's like, oh, like the investment didn't work out, and he said, oh, it just was a retailer. Retailers are not very good businesses, but that's just whatever. But that's by the by. What he's trying to do, even at 99 years old, is still grow as a person, grow as an investor, still learn. And that's what I say, aim for something that you can grow as an investor, but also aim for something that allows you to become to continue to hold that buying power. This is really what I wanted to kind of explain. It's really about having retaining that buying power in the portfolio as a whole. And now when I come to the last section that I think is helpful as well when thinking about when to sell. So I think in my experience that an approximately 18-month period is a reasonable holding period. And I have shortened that up and I've slightly lengthened that up in certain circumstances, but I think that it's helpful to think about this as an 18-month period because of two things. First, it forces you. You're going to be with this business for 18 months. It's a year and a half. Like as you get older, kind of every year like just runs past you, but it's those years really count. So you have to put in the work to understand what you're getting involved with. And everyone does mistakes. As I gave you the example of Charlie Munger, right? So everybody's going to make mistakes. But it's so important that you put in the work to understand as much as you can, so that when the business goes through the inevitable volatility, you are able to stay with that. Now, I'm not saying that you stay with a business just because you're stubborn, but I'm just saying understand what you own so that you can have the stamina to stick with it. Because there are times when markets go crazy and things just sell off, and it shouldn't sell off, but there's a moment of panic. And obviously, the example that we all remember was in March 2020, when everything just collapsed. And then it was like, people were like, actually, everyone's going to be at home. Maybe these work from home stocks will do well. And then everyone just kind of started jumping on that idea. Now, the point I'm making is that in hindsight, we now know that those were really good times to invest. But my point remains that if you understood the businesses that you own, you might say, okay, I really want to stick with this. And, we're all human. So Warren Buffett, like best investor ever, he was all in the airline stocks. And then when the airline market just collapsed, he also sold. So we're all human beings, okay? But I think that it's important to keep learning, number one, and do the homework, understand what you're getting involved with, and leave room for error, because you're going to make mistakes. And that's why I say average in and average out, because while you're a shareholder of that company, you're learning about that company. And then you can come back in a future period, those lessons that you built up, you can kind of deploy elsewhere. So the example that I like is that when I was young, I kind of used to go to Blockbuster a lot, and I was like, oh man, like I just love Blockbuster, and I just wanted to kind of get like loads of movies from Blockbuster, just go crazy. I kept on dreaming that one day I would go into Blockbuster store and just stay there the whole weekend and just watch every movie there. But their business model was not aligned for that, right? You get a movie and they'll charge you per movie. And now obviously we know Netflix is about binge watching and literally giving you as much as you want, like giving you everything. And that obviously that business, you're aligned with the business model, you as a customer is aligned, but it's a lesson that you've learned over that. So my lesson with Blockbuster is, I never invested in Blockbuster, but it's an experience that I learned, and you can use that experience in the future. So, more than a decade later, I'm looking at different businesses with that lens. So when it comes to selling a stock, you want to also take these learnings, and these learnings not always necessarily applicable for the next stock that you buy, but it could be applicable for 2, 3, 4 years down the road. So it's really important to have a bit of reflection. And I've said this before, and I'll just say it the final time, that just write 2 or 3 bullet points for yourself of like what you're doing, because your mind tricks you. I play a lot of chess, and for me, it's always really painful when I lose a game. I'm like, oh my God, what a disaster, blah, blah, blah. And when I kind of win a game, I'm like, yeah, whatever, just next one, restart. And I kind of went over the track record of these chess games that I play, And I was surprised that actually kind of came in at 50-50. I was like, oh my God, I had so much pain and I felt so down that I was kept on losing because I wasn't checking. And it doesn't take many minutes to check the progress of your stocks. You just write 2 or 3 bullet points, and then once every 90 days, just say, okay, I thought this, and I just make a little update. I've said this before, put it on a Google Cloud spreadsheet, just so that it's just easy. It's anywhere you go, you can just check it. It doesn't take a long time. Yeah, and that's kind of my. Hopefully, I've tried to explain what I'm looking at when it comes to sell. I didn't want to just put, if the stock is at this amount and it's gone up this amount, because things change all the time. I wanted to give you something that I hoped was more practical and more applicable on a broader way. Yeah, okay, and I'll open it up to questions. Hopefully, you'll have some questions, and we can kind of take it from there.
Oh, by the way, I looked up, I think Margin of Safety by Seth
Yes,
Klarman.
Klarman. Yeah.
Yeah, I just looked it up while you were talking.
Thank you so much, Seth Klarman. Yeah, he has a great book. Well, no one has any questions. I'll kind of just talk very briefly about Seth Klarman. So the margin safety, when he wrote it, he was 25 years old, and incidentally is the same age, I think, that Buffett started his partnership. And when he wrote it, it was just a nothing book about investing. Because he never allowed the rights for it to be more thoroughly published, there's only a limited amount of stock. It's like a supply and demand thing. So if you want to, and obviously there's PDFs you can just download illegally and you can read that. But if you want to buy the actual book, the book is like costs thousands of dollars. So I read the book. I didn't buy it. I just, I got hold of it. And I just find it so interesting. Like, he talks about speculation in a way that I think is quite interesting. He says that he has this kind of joke about that these sardines are for trading, they're not for eating. Has anyone kind of heard that joke before? Yeah, and it's like, it's the same we're trying to do here. We're trying to buy those cash flows of businesses. Now, in the best case scenario, you buy the cash flows of a business that can grow at approximately, let's say, I don't know, like 7-9% year over year, and you'll be paying it with a low enough multiple. The problem is that businesses, like the great recognized businesses, are often really richly priced, aside from the rare circumstances where the market goes chaotic and everything is going chaotic. So it's difficult. Obviously the Microsoft and stuff like that is but they're just so well recognized as being so valuable that the forward expected returns, in my opinion, from this point forward, it's kind of difficult to meet those expectations. You come away from a period of very low interest rates where the tax rates were low. It's kind of difficult for those businesses. They've already had a lot of tailwinds. Like, all those tailwinds have already happened. So I find it quite difficult to get involved with those businesses. That being said, I do own and recommend Google. I don't think that's really as richly priced. But you can make the argument that Microsoft is a better business and blah, blah, blah. But the point I'm trying to make is that it's really about you trying to grow the portfolio. That's really, and I'm also trying to work quite hard to minimize my losses. I'm trying to leverage these two things. I'm trying to leverage the time and the capital. It's really, I'm trying to be very acutely aware of these aspects, these two levers that I've got, and I'm trying to stick with businesses that I believe can do well, and I'm trying to just shed businesses that I don't think are going to do very well. I'm not particularly, different styles of investing. I'm not really looking at the share price. And for example, sadly for me, HIMS is down a lot, and that kills me. But the business is doing really well, and I'm like, okay, it sucks, but whatever, has to go. It has to continue. I have to continue with it, and I have to, it just sucks. I wish that it was doing better, but blah, 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 and you're trying to see, okay, where is this business going to be like in the next year? And you're always trying to think about that, because you're always trying to think about, okay, I've held this business for more than 18 months, but I'm trying to see, like, what are people looking at for next year? And are the expectations now low or high relative to where I see the business next year? And that's what I'm really trying to do. So I have this kind of strict 18-month period, but I'm very much thinking I'm always thinking every quarterly update, what are people looking at next year? I always put this little chart of revenue growth rates, because I think that really just kind of puts me on that path that I'm really focused on. What are people thinking about next year? Always next year. Because the market is always a forward-looking machine. Yeah. Are there any other questions, perhaps?
Yeah, if
Hi.
I may.
Hello, hi.
One question I would like to ask you, and it's based on my personal experience. If you sell, do you sell, I would say, forever, or do you perhaps still keep the stocks you sold on your watch list? And I'm asking because I recently, just for my learning, revisited many of the stocks that I sold several years ago. And I'm thinking, okay, perhaps it's nice to look at them again, because the thesis I had did not play out then, but now it may be the right time for it. And I have an impression, and perhaps it's another psychological trap, that many investors sell because they are dissatisfied, and perhaps they can a very good reason to sell for the next 2 years, because they see that it will not play out. But perhaps if in these 2 years they will come again and revisit this stock, perhaps that will be best, for opportunity.
So
I do not know if I made myself clear here, but
yeah. So two parts to it. So yeah, I definitely keep following the stocks. I definitely do that. But in my personal experience, if I've sold out of a stock because it didn't work out, in my experience, when I've returned to that stock in the future, I have not been successful in the second time either. So I've learned my way. I'm done. I've been there, and it always looks like, the thing is, as I said before, I gave you this example that you kind of get familiar with the businesses and you kind of feel like you understand them. And when they've kind of come down a lot, you sell and you give it time, you relax, you come back like a year later and you see that it's even cheaper than when you sell. And you're like, okay, I kind of understand what's the problem here. I'm ready to go. And, you kind of go in there and it even disappoints you even more. So in my experience, I think that it's much better for to remind yourself that in investing, you're not trying to satisfy your ego. You're trying to make money. I think that that's really very, very important to think about, because I think that we all kind of get caught up with this idea of oh, I got it, and like it's a vengeance and I'm gonna get you, and it's just pointless. I think that it's much better to keep your ego for other things, have other passions on the side perhaps, but this is the place that you're trying to reach financial independence, and that's what you're trying to do. You're trying to compound capital, and that's don't try to overthink. Don't try and kind of make yourself feel greater than it is, so that then you can go back and tell your friends like a cocktail story. Oh, I did this, that, like this is the business of trying to make money, and that's it. There's nothing else happening here, and any allusion to anything else is just distractor information. It's really, really important to have a very firm understanding of what you're trying to accomplish, I think.
I had a question, Michael. I was just wondering, you mentioned the kind of a time period of about a year and a half as like your minimum for holding a stock. But, at the same time, you pointed out the issue about, being able to change your thesis hypothesis. To that extent, what kind of, change would you have to see to maybe break that rule, right? And has that ever happened maybe where you own a stock that you intended to own longer, but ended up selling sooner?
That's a really good question. In my memory right now, I'm sure it has happened that I have sold in less than a year, but I'm working very hard to be, the example I gave is like the athlete going to the Olympic Games. They kind of know their time. Like they know what they're gonna, like they spend like their life, every dinner time, every meal, every sleep in preparation for that moment. So that when you show up, you kind of have a good understanding what should be happening. So you're trying to do the preparation. Now I have this rule of 1 year to give the business time, right? Because sometimes you invest something and then next quarter the results are really not how you expected it, and the stock is down 30%, and you're like, oh my god, like what's going on, blah, blah, blah. But I don't want to just give up straight away. I'm not having some kind of commitment bias, or I'm just trying to say, okay, let's learn, let's use this experience to learn a bit more about the business. And it's, you know, it's okay to say it's not working out right now, and I don't need to send more capital after it, right? What you're trying to do is preserve that capital. Buffett's rule number 1, right? So you're trying to preserve that capital, so you don't need to send more money after bad money. Don't need to average it down. Just something's not working, just sit on your hands. I always say to people, the most difficult thing an investor can do, and also the most rewarding thing an investor can do, is just sit on their hands and just let tempers calm down on both sides of the equations. You know, people kind of get so passionate about so many things. So look, to give you a short answer is I try very, very hard to stick to at least a year. I don't need to stick for a year and a half if things, you know, I see that things are not working out. But I'm trying, if possible, to become a better investor and to buy slightly more stable businesses so that there is no kind of negative surprise coming somewhere. I'm trying to buy businesses that are kind of somewhat predictable. I don't want something that kind of can go up a lot, down a lot. So because those are difficult to buy, you know, they look great and they make for terrific stories, but I'm trying as much as possible to buy a business that is a quality business. Now, this kind of gets into kind of different buckets. Oh, I'm a value investor, I'm a quality investor, blah, blah, blah. But it doesn't matter. It can be a cyclical business. Like, you know, we both like Vermilion. That kind of, it's like, it's a business that, you know, there's some kind of stability to it. I know that like in 2022, natural gas prices went really high and now they just collapsed and now it's kind of coming back up or whatever. But I'm trying as much as possible not to have too many negative surprises. The market's going to throw enough at it, but the business, the underlying business, it's stable. That's really, so it gives me time to stick with the business. And it's often the case that, you know, when the business has a bad quarter and you look back to it 6 months later, and actually things have actually turned around and improved. All those people that kind of didn't want anything to do with the business, they're sellers, they were, you know, quote unquote weak hands, they sold out of the business, and you just gave the business time and the business turned around. Because remember what management is trying to do as well. I know that shareholders and management often seem like they're kind of a loggerheads of each other, but management also, they get up on Monday morning and they have they're highly motivated people because there's like 10 other people right behind them trying to take their job. So they're really motivated people and they're trying to improve the quality of the business. I know that things sometimes don't work out in their favor, but they're also really, really passionate and motivated, intelligent people. So you're trying as much as possible to have these tailwinds and give the business time to right its wrongs.
That makes a lot of sense, yeah.
Are there any other questions for today? Hi, George. Yeah.
Just this morning I saw someone, I forget who it was, but a rating of ALB to go down, I think even below 100, but they forecasted they lowered their expectation. So there's a temptation, isn't there not, to say, well, before it goes any further, I sell now and buy it back. What do you think of that kind of thinking?
So we're talking about Albemarle, which is lithium, it's a lithium stock. I saw that as well. So speaking objectively, speaking it straightforward, this whole energy transition has not been working out. Everyone had this expectation that electric vehicles will be ramping up and there'll be massive demand for lithium, and that, you know, there's going to be loads of storage energy for like solar panels and wind turbines and all that kind of stuff. That hasn't really played out. Like, that's a fact. Doesn't mean that it's not going to play out next year, but truthfully speaking, it's not working out right now. But this kind of selling and then trying to time the market at a better time, I think that it's really difficult. It's so difficult. And the problem is, I've seen this in my own experience, right? I've seen this in my own experience, that you sell a stock and just you shut it from your memory. And when you look back at it again, it's like above where you sold it, and you're like, oh my gosh, like, and if I just sat on my hands, because like, for example, you're already down in the stock. I'm not saying that I'm not waiting for break even, like nothing like that. But I just know that people's passions kind of get too intense at some point. And it's important to kind of just say to yourself, okay, let's just give this a bit of time. But I recognize copper and lithium, this, which is tied up to the energy transition, is not playing out. That's just a categorical fact. I was looking at like this whole thing about solar panels and wind turbines, like countless stocks like Siemens Energy, which is basically one of the biggest manufacturers of wind turbines. Their share price is just like also like just going down and down and down. So I've seen that this whole thing about the energy transition hasn't worked out in 2023. But I also believe that, you know, there's a quote from Bill Gates that we overestimate what we can accomplish in 12 months, but we underestimate what can happen in 10 years. So it's that kind of thing that I know it's not happening right now, the energy transition, this is a fact, but, you know, things will turn around. Things absolutely will turn around. And the thing with the commodities is that it's not like other business, but with commodities, the cure for low prices are low prices. When things kind of get really too cheap, it becomes unprofitable to mine it, and then there's like a bit of a tightness in supply again. And lithium has really come down a lot. It's like down 70% in the past 12 months. So you know, it will stabilize. It absolutely will stabilize. Just to conclude, I don't think that, in my experience, that I've been doing this, it's too good to get charged up and try and kind of time the stock. When something in my mind isn't really working out in the portfolio, I just say, okay, I'll sit on my hands. Let's just take it easy. Like, let's look at other things, because there's other things that do work, right? You and I have discussed about like things working, like in Antero Resources, whatever. So other things are working. I don't get too caught up in that. Just give it time. And that's why I said about the 12 months, you know, just kind of sit on your hands and see how things play out. You learn so much. Like 12 months ago, I honestly believed that this whole energy transition is going to work out. And I was like, oh, everyone's going to be like, but it didn't work out. But it doesn't mean it's never going to work out. It's taking time a bit longer.
Thank you, Michael.
Thank you so much. Okay, guys, thank you so much for coming. Really appreciate it. You know, really kind of you. Thank you for great questions. And if you have any other kind of topics that are interesting, please let me know. Like if there's anything else that you're kind of interested in. Okay. Thank you so much.
Will do. Thank you for bringing us, Michael.
Thank you so much. Thank you. See you soon. Bye-bye.
Bye-bye.